Hello, everyone. Welcome to the weekly roundup. Today we will cover inflation, housing data, and investor sentiments. Hello, Ben.
Hey, Eva.
This week, so we went from hot to cold today. It's crazy.
Yeah, we dropped like 25 degrees, I think.
From 40 something. That was
Yeah,
intense.
it was 14 and a half when I was going to a meeting today. Wild.
You never know what you get.
It's Ottawa.
Yeah. Okay, let's get into it. So starting with Canada's May inflation, it held steady at 1.7%, with core measures easing to about 3%. Is this a temporary pause in inflation or the start of maybe a new, more stable cycle?
Hmm. Good question. I think it's interesting time. Because we went through this inflation impulse during COVID, I think there's this natural tendency to think that we're going to get an inflation impulse every time. And so, at least our economics team still thinks we are slowing and we think inflation's coming down. Coming down to 3% is probably a great thing as well for the Bank of Canada because their band is like 3% is the top of their band. And so as we start to come down into the lower end, which I think we continue to still see that, is it gives the Bank of Canada still some room to further cut rates. And so we'd still be in the camp of 75 basis points this year because we think inflation's coming down, and that would be different than the street. But certainly we think inflation's coming down. To your point about core versus CPI, yeah, I mean, the core is still a little bit sticky and CPI continues to come further and further down. But yeah, we still think that it's heading lower.
Okay. So Powell's congressional testimony, did he give any hints on the monetary policy path? And this is considering the unexpected decline in consumer confidence data.
I think a little. I think he's in a real awkward position here with obviously, I don't think any president's ever liked the Fed chair, but in this particular position, there's quite a bit of animosity between him and President Trump. And so it's difficult to see what he's saying and doing is reflective of exact policy at the time. But yeah, he tended to say that. Um, the path forward has to result in softer rates and lower rates. And so, if you look at housing, which housing numbers in the US came in tiny bit better than expected. But generally speaking, you're seeing listings increase like crazy in pretty much every city in the world or every city in the US. And the housing market continues to slow there, and it's a big driver of consumption. And so, to your point, I think, yeah, the consumer is feeling nervous. Part of it has to do with housing, and part of it has to do with uncertainty. There's a lot of great clips that come out of US when you're watching Congress and interviews and such, and the things that people consume are going up in price. So tariffs are causing Americans to spend more, which is obviously the counter of what he's saying is going to happen. But it's causing Americans to spend more on their daily household goods, and so they're feeling much more uncomfortable about what that's going to mean. Ultimately, it probably forces the economy to slow a little bit faster than he'd like. And if you look at markets, and we've talked about markets, and US markets have been one of the worst performing markets in the world. We saw the Greek market is up 50% year to date. So when you look at like the economy in the world, the economy is saying we're slowing, markets are saying we probably agree with you. And so Powell tends to suggest that the path ahead is lower rates. And lots of the data is continuing to support that for him.
Okay. Let's talk a bit more. What is the real story behind home listings in the US? This seems to be returning to focus. Is this cooling demand? What does it say about rates, potentially inflation? Let's unpack this a bit.
Yeah, so US housing is a big driver of their economic activity. And so I think first what we saw was when President Trump got in that there was going to be a lot of job losses in Washington. And so you saw Washington obviously spike right away because people started to list their house and so on and so forth. The big number, though, really is their mortgage rates. And so if you look at how US structures their mortgages, they're all based on the 30-year mortgage. So 30-year amortization and 30-year locked-in rate. And so when that number gets up to 7, where it is now, it tends to put a material drag on the economy, but also make people more and more concerned about their ability to continue to afford their home. And so I think there's some of that. The uncertainty is driving people. And the other number, which we haven't talked about, is consumer credit. So our US consumer credit is 20 something trillion. And Canadian consumer credit just came out at 2.4 trillion today as well. So this is X real estate. So this is just your consumer debt. And so if you're getting pressure over on this side, where you're paying 20% rates on your credit cards, you start to look for another avenue to generate some revenue to pay that off. And so that's why listings are popping up. And so I think it's a number of things, but higher rates, stretch consumer is really driving the market to increase their listings.
Yeah. Let's talk about the market this past week, especially commodities markets, given the geopolitical tensions. How has investor sentiments been generally?
Yeah, I mean, on Sunday night when I read the headline, as I'm sure everybody did, and that Iran and the US and Israel were all going to war. Um, and then when the futures opened at 6 p.m. Sunday night, it seemed like nobody cared. The Brent oil was up 5%. This type of event, I thought it'd be up 25%, or more, given the severity of this. And as you know, the Strait of Hormuz, where like that oil comes through, something like 70 to 75% of the world oil goes through there every day. And so if that gets shut down, that's going to have a material impact on prices. But the market seemed to say we don't care. So I don't think that's the right case or the right answer. I do think it's a bigger thing to be concerned about. I don't think this is a lasting ceasefire. I do think that there's plenty of ground to cover between now and then. So lots of choppiness in commodities. Yeah. So up 5, down 6, up 8, down 4. So we've had lots of volatility in oil. We do have a position in commodities, and so it's the commodity position is really a hedge against this type of event. If we get a material shake to the world order, then you probably see commodities move higher, and that position would go up in that backdrop. But yeah, it's been quite volatile in the commodity space. Rest of the market didn't care too much, and US dollar has been super weak, which is also interesting.
Okay, let's see the charts.
All right, so we are recording this on June 26th at around 1 p.m. So anything that happens between now and then won't comment on this week. Obviously, we'll touch base on next week. So this was definitely been an interesting piece. Lots of talk about what's going on, not piece. That's more of where the military spending is coming. And Mark Carney has talked about increasing the expenditure. And this is, I think I put out another piece this week just talking about him going up to 5% of GDP spent on defense spending. They said 3.5% specifically for defense and another 1.5% towards infrastructure and such to support the defense industry. So 5% GDP. I mean, if you look and see where we are today here, below 1.5. I mean, if we move up to the 5% level, that puts us up past the U.S. in that backdrop, and puts us as probably the country that would spend the most on defense. Obviously, this is music to the ears of the United States. I think it will win us some points in the negotiation process that way. This is good for Canada as well. The negative side, which is the fiscal individuals that will follow and track this, is what's going to be deficit spent in order for us to get to 5% of GDP. We're going to have to issue more debt in order to pay for that. But certainly lots of interesting pieces. And, he said, let's get to 2%. He said, let's get to 5. So this is worth paying attention to and seeing, where Canada goes from here. But it looks like certain commitment to providing more stability to the country and a real significant commitment to defense. So I think that's a good thing for Canada. So I've been talking about China for quite some time, and I think we talked about real estate off the top. Obviously, U.S. real estate. This is Chinese real estate, and so this is the China Home Prices Index, 70 city residential. So this would be most of the big cities. Drawdown from the peak. I mean, resale. This is material. We are down 18%. It continues to go lower. New homes are only down 10%. It's something to do with how the banks finance those two resales and new homes. But when I talk about stimulus and liquidity in the system, and I've talked about M2 on and off, China really still has a lot of powder, and they still have a lot of ability to stimulate, cut rates. This figure that they're looking at is certainly going to push them to make some decisions in the back half of this year. And so I think this would be an important piece to watch, and it'll play a material part for what happens with the rest of the world. So Eurozone inflation. So I know we talked about Canada and the US off the top. We can touch on China there. This is just a little bit about Europe. And so we look at what's been happening is the euro has continued to weaken. So the euro has been strong and the US dollar has been weaker. So just as we look at this chart, it says the euro is another factor that opens up the door to further rate cuts. So is inflation. So if you look at their core inflation, it's down to 2.3%, services down to 3.2%, and then headline is below the 2% level. And so, a strong euro allows the European Central Bank to continue to cut rates. And so we anticipate that the European Central Bank will continue to cut rates in the second half of this year. And if you looked at, there was another central bank this week, which was Switzerland. So Switzerland has a really strong currency as well. So they brought their overnight rate to 0, with talk of potentially going into the negative again. So it just shows you how much interest rates and inflation and currency plays a part in what happens in the world. So I thought this was an interesting chart, and further shows that Europe will continue to cut rates in this environment, which plays a part on many different assets, and part of why I say the US dollar is one of the most important things to watch. So the opinions expressed in here do not necessarily reflect those of National Bank Financial. If you have any questions, certainly feel free to reach out to me or speak to your advisor. I appreciate you listening, looking at the charts today. I got to get this. Here we go. Stop sharing.
Okay. There. So what's on the agenda for next week?
So we get into I'd say the end of the month here. So Monday is the last day of the trading month. So we're getting probably a fair amount of trading and cleaning up as we wrap into the end of the quarter here, end of the second quarter. So we'll be watching that. I still think let's say the military conflict in the world will be important to continue to watch. Ukraine, Russia has been off the front page of the paper these days, but it continues to rage strong. While it may not be getting the attention, it continues to be an issue to watch. And I think the conflict on Iran is not done. And so we'll continue to pay attention to that. From a market perspective, sentiments moved pretty positively. So I'd be thinking, okay, where do we go from here? that one piece which I mentioned and continue to talk about is US dollar. And so as the US dollar continues to weaken, that makes the US more attractive for a manufacturing perspective. But if the US dollar is weakening, that means other currencies are strengthening. So there's knock-on effects to that. And so I'd be paying attention to what happens to the US dollar from these levels as you've seen it continue to weaken, which is effectively the market saying that stimulus is coming and the actions that President Trump is taking is slowing their economy and they need to find a way to make some changes. And so weakening US dollar tends to signal that there is stimulus ahead and probably is good for international emerging markets. At least it has been historically. So we'd be watching that quite closely.
Okay. Thank you, Ben. Thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. As always, the link to our daily financial heartbeats will be in the caption of the video, as well as in your email box. For our clients, reach out to me if you'd like to book a review meeting with Ben or if you have any questions. Thank you, everyone. Have a great Canada Day next week. Bye.
Thanks. Bye.